Welcome back to the Pro Ticker Podcast, your Monday morning edition, covering major financial magazine headlines, everyone. It is Monday, March 9, 2026. And I have to say, looking at the screens today, we are staring down a morning where things are just flashing red and green in completely opposite directions.
Oh, it's wild out there. The complete split screen.
Right. So for today's deep dive, we've pulled a pretty massive stack of fresh reporting. We're looking at sources across CNBC, Bloomberg, Reuters, and Yahoo Finance. And our mission today for you listening is to really unpack what feels like two alternate realities that are just colliding in real time.
Yeah, that's the best way to put it.
Because on one hand, we are tracking this unstoppable, incredibly capital-heavy boom in AI infrastructure. But then on the other hand, that whole digital dream is running headfirst into a violently physical, geopolitical, and energy crisis.
And it threatens to choke off the exact resources the tech sector desperately needs.
Yeah.
It's a study in extremes today. You have institutional money just sprinting toward this futuristic promise of superintelligence, right? Almost completely ignoring macroeconomic gravity. While at the exact same time, the broader global exchanges are in aggressive panic selling mode.
Because of the physical world.
Exactly. Blocked trade routes, skyrocketing oil prices. The digital future is quite literally crashing into the physical present today.
It is, because pitching the biggest infrastructure project in human history, it sounds great in a boardroom, but as we're seeing this morning, there's a glaring physical limitation. It requires just an absolute ocean of electricity and physical materials to build.
Right.
So let's start with the digital ambition side of things, because the numbers jumping off the pages of CNBC today are just staggering. We are looking at a UK-based AI data center startup called Netscale.
Oh, yeah. Netscale.
And just closed a Series C funding round, and they pulled in $2 billion. $2 billion, which rockets their valuation to $14.6 billion.
Yeah.
And honestly, the part that blows my mind is that they only launched in 2024.
That timeline is, well, it's what really stands out to anyone watching the venture space right now. In barely over a year, they have positioned themselves at the absolute center of the physical build-out for AI.
Yeah.
And just look at the roster of capital backing them. You've got NVIDIA, obviously, providing the silicon bedrock. The round itself was led by Aker ASA and 8090 Industries. But then you look at the broader participant list.
It's heavy hitters.
Citadel, Dell, 0.72.
Yeah.
You've got Jane Street, Lenovo, Nokia. I mean, when you have that much institutional weight hedge funds, hardware giants, sovereign capital moving in total unison, they aren't just placing speculative bets. They're trying to own the foundational layer of the next technological epoch.
And they are assembling a corporate board to match that massive ambition. Netscale just added former Meta Chief Operating Officer Sheryl Sandberg.
Huge name.
They added former UK Deputy Prime Minister Nick Clegg and former Yahoo President Susan Decker. I mean, you don't bring in a former Deputy Prime Minister just for tech advice.
No, absolutely not.
You bring them in to navigate global permitting and national security regulations and European power grid politics.
Precisely. And if we connect this to the bigger picture for you listening, it really helps clarify what Netscale is actually doing here. Because we have this habit of conceptualizing AI as just software, right?
I think it's just floating in the cloud somewhere.
Exactly. Something invisible living in the cloud. But the cloud is just a physical building filled with someone else's computers. And Netscale is out there building vast physical facilities filled with incredibly dense GPU compute and networking gear.
Across Europe, North America, Asia.
Everywhere. And they have a $14 billion expanded partnership with Microsoft. They're working with OpenAI on a Stargate-branded data center over in Norway. They are pouring concrete, erecting steel, securing these massive advanced water cooling systems, and laying thousands of miles of fiber optics.
It's like they're essentially trying to build the Death Star, but they're doing it at light speed.
That's a great way to look at it.
In fact, Netscale CEO Josh Payne, he actually told CNBC that this AI boom is driving the, and this is a quote, largest infrastructure build-out in human history. He called their facilities the engine of superintelligence. And with a $14.6 billion valuation, they're even already eyeing an IPO.
It's an incredibly bold pitch.
Yeah.
But the power density of these new NVIDIA chips, it backs it up. You aren't just talking about throwing some servers in a warehouse. You are talking about facilities that require hundreds of megawatts of power to function.
Which brings us perfectly to the morning's other massive headline. Because you can secure all the venture capital in the world and you can buy all the silicon off the assembly line, but you still have to physically plug these facilities into a power grid.
Yeah, you do.
And right now, the global energy complex is in a state of absolute chaos.
You cannot manifest a digital superintelligence without the physical energy to run the servers. It just doesn't work.
And that global energy supply is currently under severe immediate threat. Let's look at the breaking news out of the Middle East that's dominating Bloomberg and Reuters today.
It's grim.
It is. The war in Iran has entered its 7th day. And the critical catalyst that is just terrorizing the markets this morning is that the Strait of Hormuz is now largely impassable.
And to really understand the gravity of that for the markets, we have to look at the geography and honestly, the math.
Right.
The Strait of Hormuz isn't just a shipping lane. It is the ultimate global choke point. At its narrowest, it's only about 21 miles wide. But roughly 20% of the world's total oil and gas supply moves through that specific stretch of water.
20%.
20%. And you can't just easily pipe that volume over land. When you physically choke off a fifth of the global energy supply overnight, the market reaction is going to be incredibly violent.
Violent is the exact right word. Because for the first time since Russia invaded Ukraine back in 2022, crude oil blew past the $100 mark today.
Just skyrocketed.
West Texas Intermediate jumped 20%. That's an $18.30 spike in a single trading session, hitting $109.30 a barrel. And the global benchmark, Brent crude, advanced 18% to $109.35.
Insane moves.
When traders see a vertical line like that on a commodities chart, they aren't just looking at the price of gas at the pump.
No, not at all. They are immediately modeling out the downstream destruction. An oil spike of that sheer magnitude acts as a massive immediate tax on the entire global economy. Every single physical widget that moves on a ship or a train or a truck just got significantly more expensive to transport.
And the ripple effect across the equities board was brutal this morning. Dow futures tumbled between 600 and 900 points. The S&P 500 and NASDAQ futures fell sharply.
And we saw bond markets plunge globally, which is really where the mechanics of the macro fear take hold.
Break that down a bit.
Well, when oil spikes 20% overnight, bond traders are pricing in the fact that inflation is going to run hot again. And if inflation runs hot, central banks cannot cut interest rates. In fact, they might be forced to hike them again.
Which makes capital way more expensive.
Exactly. The cost of borrowing goes up, and that crushes the valuations of tech companies that rely on cheap debt to fund their massive growth. It completely upends the macroeconomic assumptions that traders have been operating under for the last year.
And we saw that panic spread everywhere. In Asia, the reaction was so severe that South Korea's Kospi index sank fast enough to actually trigger a circuit breaker.
Wow.
Yeah, it automatically halted trading to stop the bleeding. Even gold retreated. Which, I'll be honest, that surprised me initially. Why would gold drop during a massive geopolitical crisis?
Right, because traditionally gold is the ultimate safe haven asset during wartime. But it dropped because investors were likely forced to sell their gold to cover margin calls elsewhere in their bleeding portfolios.
Ah, a liquidity scramble.
Exactly. It's a pure liquidity scramble. Plus, that fear of higher for longer interest rates makes non-yielding assets like gold less attractive to hold compared to treasury bonds.
Okay, so we have a full-blown economic firestorm, which immediately turns into a political one. And before we look at the Washington response, we want to take a second to directly address you, the listener.
Yes, very important context here.
We are pulling directly from the source texts here. We are looking purely at how both sides of the political aisle are trying to navigate this massive shock. The market is actively pricing in both of these political narratives, so we are going to lay out the factual accounts of these arguments strictly as they are reported.
Right. We want to be absolutely clear that we are not endorsing either viewpoint, right-wing or left-wing. We are simply conveying the ideas and the friction shaping the markets today.
Exactly. So let's look at the Trump administration's immediate posture. According to CNBC, President Trump took to Truth Social to address the surging energy costs. He framed the short-term oil prices as, and this is a quote, a very small price to pay. He's pointing toward broader strategic military goals in the Middle East.
But that tolerance for short-term pain is facing intense, immediate pushback from congressional Democrats, particularly regarding how this Middle Eastern conflict overlaps with the ongoing dynamics with Russia.
Yeah, we saw a highly critical letter sent directly to Treasury Secretary Scott Bessent from Representative Sam Liccardo of California and Senator Ruben Gallego of Arizona.
And the core of that letter is a strict demand. They want to immediately reverse a temporary 30-day sanctions waiver that the Treasury Department recently issued. Now, this waiver allows Indian refiners to continue purchasing Russian oil.
And Liccardo and Gallego called the waiver dangerous. They called it self-defeating and indefensible. Their argument is that by allowing this oil to flow, the U.S. is handing Russia a multi-billion-dollar financial windfall, precisely when global oil prices are skyrocketing. Right.
Furthermore, the letter cites reports alleging that Russia is actively assisting Iran in targeting U.S. troops and aircraft in the region.
It is a classic collision of geopolitical strategy versus economic pragmatism. The Democrats are arguing that this waiver functionally rewards a geopolitical adversary who is aiding attacks on American forces. They're saying it signals that the U.S. will tolerate sanctions evasion if the economic pain gets too high.
But the administration is defending the waiver as an absolute economic necessity right now. U.S. Energy Secretary Chris Wright came out publicly to defend the move. He called it a pragmatic step. And based on the reporting, Wright's defense is essentially a strategic balancing act. First, by allowing Indian refiners to buy Russian oil, it prevents that oil from being bought up entirely by China at a steep discount. Second, and arguably most critical for the immediate panic we are seeing on the trading floor keeping, that Russian supply on the global market helps alleviate those sheer vertical price spikes we just talked about.
Wright is also attempting to project calm into the markets. He stated that the closure of the Strait of Hormuz represents a worst-case scenario of a, quote, few weeks, not months. So he is heavily telegraphing that the U.S. military response will secure and reopen the strait relatively quickly.
Yeah, he's trying to manage expectations.
But the clock is ticking incredibly loudly for the administration here. Let's look at the calendar. We are less than 8 months away from the midterm elections.
Yep.
Control of Congress during the second half of Trump's term is entirely on the line, and polling consistently shows voters expressing deep, intense concern about affordability and the overall economy under Trump 2.0. I mean, if gas prices climb to $4 or $5 a gallon, that affordability crisis becomes the inescapable dominant issue for voters.
It absolutely does. A prolonged closure in the Middle East deepens the energy cost crisis, it heavily burdens the consumer at the pump, and it severely complicates the economic narrative going into a crucial election cycle.
But we have to zoom out even further because the fallout from a choked-off Strait of Hormuz is not contained to Washington. It triggers a huge global domino effect.
Yes, starting with the situation on the ground in Iran itself, which is shifting rapidly. Today's sources confirm a major internal development. Iran has officially named Ayatollah Ali Khamenei's son, Mojtaba, as its new supreme leader.
And that leadership transition introduces a profound new layer of unpredictability to an already volatile theater. You can see the anxiety reflected in the frantic emergency-level diplomacy happening globally right now.
Oh, absolutely. The G7 is convening an emergency meeting in the coming days.
Yeah.
They're actively discussing a joint, coordinated release of emergency oil reserves to try and flood the market with enough supply to break the fever in crude prices.
At the same time, the calendar is marked for a really critical bilateral summit. President Trump is scheduled to meet with Chinese President Xi Jinping from March 31 to April 2.
And the China factor here is massive.
It is. While the West is terrified of stagflation, veteran Wall Street strategist Chris Rupke warned today that, quote, all the ingredients are here for recession in the U.S. China is desperately trying to manage a completely different set of macroeconomic problems.
Right. Beijing just wrapped up a top economic policy setting meeting. They kept their consumer inflation target at around 2% for 2026. But the real story is their growth metric. They lowered their GDP growth target for the year to a range of 4.5 to 5%.
Which is incredibly low for them.
It is. And this is exactly where the global supply chain dots connect. To hit even that lowered 4.5% GDP target, China is relying overwhelmingly on their export engine. They need the U.S. and Europe to buy their manufactured goods.
But look at how this oil shock boxes Beijing in. If the Middle East tensions don't de-escalate, pushing up gasoline and raw material prices globally, the cost of manufacturing in China goes up.
Exactly.
If the West slides into an energy-driven recession, meaning American and European consumers stop buying Chinese exports because they're spending all their money on gas, China is in deep trouble.
They'd be forced into a corner. Economists are warning that China might be forced to implement incredibly aggressive, proactive fiscal stimulus just to protect that GDP target. They would have to pump hundreds of billions into domestic consumer programs just to keep their economy afloat.
It is a stunning web of interdependencies. A 21-mile stretch of water in the Middle East gets blocked, And suddenly, U.S. bond markets panic, American midterms are threatened, and Beijing has to potentially rewrite its entire fiscal policy.
It highlights the extreme fragility of the physical systems that our entire global economy relies upon.
Which brings us full circle to the incredible dichotomy we started with on this deep dive. On one hand, you have companies like Nescale raising billions, building the digital promise of AI, trying to engineer this post-human superintelligence.
Yeah.
But that entire digital future is fundamentally dependent on a physical world that is, right this second, facing violent disruptions, closed trade routes, and skyrocketing energy costs.
And there is a real irony there. We touched earlier on Niscale's projects in places like Norway. Now, those specific data centers are largely powered by local renewable energy. But you still have to physically build them. You still rely on global supply chains powered by diesel and shipping lanes to move the servers, the copper wiring, the cooling units. The digital realm simply cannot escape the physical supply chain.
You can't code your way out of a closed shipping lane.
You really can't. Which leaves us with a critical long-term puzzle. I want to leave you listening with a final thought to mull over as you watch these markets process the shock today.
Let's hear it.
We know AI infrastructure demands an unprecedented amount of power to build this engine of superintelligence. So how will global tech giants secure their energy future in a world where a single geopolitical conflict can shut down a vital energy artery like the Strait of Hormuz overnight?
That is the big question.
Will the AI boom force a radical acceleration in alternative energy independence? Because if superintelligence requires infinite reliable power, it simply cannot rely on a fragile global oil supply chain.
It's a fascinating thought. You cannot build the digital future without solving the physical present. We'll see you all tomorrow morning with new headlines from major financial magazines.